Good afternoon, everybody. Welcome to the Masterclass by One Finance. My name is Sonam Khatri. I'm a VP Marketing at One Finance. Thank you, everyone, for joining. We'll wait for our audience to join in before we get started on this important topic key to effective retirement planning. It's an extremely important and crucial topic for every individual out there. We all are going to reach an age where we want to retire and live a comfortable life. These masterclass are designed in such a way that qualified financial advisors explain you, empower you to take informed financial decisions. And today's masterclass is designed exactly for that, to help you be ready for your retirement. Yes, everything cannot be taught in that 1 hour of session. Every individual has a unique way or a perspective towards retirement, how they want to achieve it and when they want to achieve it. But this masterclass can get you started and make you, empower you, and explain you why this is such a crucial part of your financial plan. That's right, retirement planning is an extremely part of a complete financial plan because you have to now and invest today, save today, or be ready today to have a very successful or at least a comfortable future. Today, joining us to explain us or to teach us all about retirement, how you should start saving, investing, how to build a corpus for your retirement, we have with us Ritesh Sabharwal. He's a CFP, around 16 years of experience in the whole financial services space. He has been empowering individuals by webinars, workshops, and not to forget, his mission is to make all individual out there financially fit. Let's introduce him and let's invite him to the deck. Please, sir, thank you so much for joining us, sir.
Thanks, Sonam, for having me.
It's great to actually have you here. Retirement planning, extremely important topic for everyone. Every individual has to go through it, right?
Yeah.
What has been your story till now when you have been meeting so many customers out there, clients out there? How is the feeling of retirement? Does people feel like, oh my God, this is coming and I'm not ready for it? Or building a corpus of crores of rupees is something that must be scary? Like, people must be losing their peace of mind actually.
Absolutely. And I think this is an excellent topic to pick up. And like you rightly mentioned, a lot of times people aren't actually even planning. We'll come to little statistics during the presentation, which will actually prove that even though retirement is far away, so people don't really plan in advance.
Absolutely.
And yes, they get scared of that big number. But the idea is that people are aimlessly investing.
Yeah.
If they don't know what that number is or how much do they need to invest, etc., then they're just aimlessly investing and they don't know if 4 crore is good, 8 is good, 12 is crore, so they don't know that.
Absolutely. To have a comfortable retirement life, you have to be invested enough to continue with your dreams, goals, everything, and not be worried 24 hours about it or not be dependent on people. Today's masterclass is for that exactly. Let's take it ahead. Let's not waste any time. In the last 10 minutes, we'll be taking a lot of questions from all of y'all. So please go out there, put your questions in the comments, and we'll wait for Ritesh sir to answer them in the last 10 minutes. This session is live right now on the One Finance website, Twitter, and LinkedIn. And do not forget to follow One Finance and Ritesh Sabharwal. So please go ahead. So thank you so much.
Thank you so much, Sonam, for setting the stage. And again, welcome everybody and good afternoon. And like Sonam mentioned, this is an extremely important topic. And what we're going to do over the course of the next 40 minutes is look at why planning for retirement is actually important. What are the factors that are involved? How do you actually calculate your retirement corpus? The next stage is once you know that you need this number, how much do you really need to invest per month to actually meet that retirement corpus? We'll then go ahead to figure out that, if I don't want to start planning now, but I let's say start planning in 5 years or 10 years, what is the actual cost of delay in investing? So if I don't plan early, what happens to my retirement corpus or what happens once I've actually reached that retirement age? We'll also look at things like impact of not getting that retirement corpus. You might figure out that you need 10 crores, but let's say you only get 7 or 8. What happens then? How do you determine what happens? Again, I'll start off by saying retirement is not a negative word. It's basically that you get the freedom to choose what you want to do, right? So you can do what you want to do with your choices. And it's just to figure out that you have enough money to sustain your lifestyle while you're in a period that you may not be getting the full income, or you've made the choice to, let's say, do something you're passionate about. So that's how we'll go from there. So let's move on and we will look at why retirement planning is actually important. So there are various factors. Okay, let's start with the poll first. Uh, I would like everyone to tell me, like, have you started planning for your retirement? So either a yes, not yet, or in progress. So let's get your answers, and we'll start with that. We'll give it about 30 seconds. So we're just waiting for the answers to come up. So, like you can see, the poll really says that 28% have said yes, 57% have said not yet, and 14% is in progress. So, I think the statistics will prove exactly what the live audience is actually indicating. That maybe only 2 out of 5 people have even started even thinking or planning about retirement. So now we talk about that. Why do we really need to plan for retirement? What are the factors that are involved? So let's go ahead. The first factor that we look at is inflation, and we'll come to an interesting slide which shows that if there's an increase in inflation, how much does that affect your retirement corpus? But what is inflation? It is basically the increase in cost of goods and services. So let me give you an example. For 100 rupees, what you had in 1979, right? When we started 100 index, today that same thing you can only do it for 2700 rupees, right? So the increase in price of goods and services really will affect your ability to manage your expenses at the time that you retire. So inflation is a key component. Let's look at the other ones. Increased standard of living. Lifestyle inflation is also something that many people are not aware of. So you see the RBI's published inflation rate, that's 6, 7% sometimes. But your actual lifestyle inflation, you started going in trains and buses, now flights. Someone started with economy, someone wants to go in premium economy. There's so many other lifestyle changes, the gadgets that you're buying these days. You're going on upgrading your lifestyle. So your inflation actually should be taken much higher than the inflation that is actually being accounted for based on just the RBI's inflation. We can also look at things like longer lifespan. So maybe if you go to the next slide, we'll see basically that yeah. So let's talk about inflation first. Medical inflation is something which is much higher than normal inflation. So if you look at it, medical inflation in India is about 14%. So the cost of a surgery, which was let's say a lakh rupees 5 years back, is more than double now. So you'll realize that the cost of medical expenses is much higher. Again, the chart really shows you the same thing that I was talking about. You can see in 2002 and 2003 what you could buy with 1,000 rupees, and how much can you actually buy it in 23, 24. If you move ahead, we'll actually see, yeah, look at these interesting stats now. Like I was mentioning, only 40%, that is 2 out of 5 Indians, have actually started to plan for retirement. That's a very, very low number, considering that there will be a large population of people who will at some point stop earning or get into the retirement age. And 61% Indians are actually worried that even if they get whatever corpus, it may not last them for the time that they have to live, basically, right? So these are two interesting stats. If we go ahead, we'll actually see again. This was based on a survey that half of India's population thinks that retirement age should be 59 years, and the planning for retirement should start at 32. Now, I said half of India's population. So, if you look at the other half, especially the newer generation, when I ask a lot of people, they want to retire at 40, 45, and we'll come to how easy or difficult that is to do based on the kind of retirement corpus, based on the kind of expenses, and based on the kind of savings and investments that people do. So let's go ahead. We look at now again a couple of other interesting statistics. Again, like Sonam was mentioning earlier, it's a random number sometimes. So based on this survey again, a lot of people thought that the required retirement corpus, it's let's say 1.3 crores. And you've heard that saying that you become a crorepati, it's all good. But again, what you're spending now in terms of your expenses, let's say 50,000 rupees is your expenses now, okay? In 20 years or 25 years at 6% inflation, that will be almost like 2.5 lakh rupees. So to get the same lifestyle, you have to spend that much. So 1.3 crore, is it right, is it not right? I can't tell you this. You will have to calculate that based on a certain number of inputs, your expenses, your lifestyle, and we'll come to how to calculate that. And then you design your portfolio and design your savings and your investments accordingly. And this is the catch where, for some, 5 could also be okay. For some, 10 could also be okay. It depends on your expenses and your lifestyle. If you're more frugal or if you're more extravagant, that's how it depends. 20% of, people think that only 20% start planning before the age of 30. Now, I again do not propagate that all your investments, or let's say your savings, should go into your retirement in your 20s. I definitely feel you should upskill yourself, you should start learning, you should try to make more income, because if you make more income, you can save and invest. You should also enjoy your life, you should not just spend. But on the flip side, all I'm trying to say is that you should be aware. The idea is awareness. If awareness can be there, then it's up to you to decide, and it's your choice. So someone extravagantly spends a lot of money on travel. Is it right? Is it wrong? There is no right answer, because for that person, maybe that is more important, and that person basically balances it by say spending a little less on other things. So ultimately, they'll still get that number in terms of how much do they need to invest. But imagine that they did not know at all. Now you're spending on the travel also, you're spending on something else, and you definitely now don't have a lot of savings to put for this retirement goal. So at least you should be aware, and then it's your personal choice how you go ahead. Okay, let's go ahead. Now, this is again an interesting aspect that I was talking about earlier. That if you look at the younger generation, or let's say the older generation, sorry, you'd see that the working years were about 40 to 42 years between the age of 18 and let's say 60. And the retirement age was much lesser, let's say about 7 years. Why? Because the life expectancy also was a little lower. But now, if you look at it in this generation, starting a little bit later, you have education, post graduation, MBA, etc., and you're starting at 24, 25. But a majority of the people want to retire early, also retire in their, let's say, 50, 55, even 55. It seems it's a higher number. What I've heard from people, it's about 45, 50. And now, I mean, whether you like it or not, you are going to live longer with medical advancements. So it is basically, you live a longer life. So imagine you're working lesser, so 30 years, and you're living longer. What does that mean? That at the time that you stop earning that income at a certain point of time, now you need a much higher corpus, because you need your money to sustain you for maybe about 20, 22 years. And earlier it was 6, 7 years. So again, there are two sides of the equation. One is, of course, managing your expenses and increasing your investments, and again, from the other side of it, which is the income part of it. I mean, you've seen so many layoffs and job cuts, etc. Of course, you should have your emergency fund. That's definitely one thing in play. But the idea is again to sink in that at that point of time you won't realize. So if you're 30 today, as someone who's 30 today, you may not realize that what will happen at 55, and when I'm 70, 75, that thing should hit you, that do I have enough money to sustain that period of time? So that's the other angle. Okay, let's go ahead. Now, if you look at yeah, this yeah, let's do another poll at this point of time. It actually coincides with what we were discussing. At what age are you planning to retire? Is it in my late 30s? Is it in my 40s? Or is it in my early 50s? So this will be an interesting response. So let's wait for it. Great. So, like you can see, in my late 30s is about 25%, in my 40s is 0%, in my early 50s is about 75%. So, it's interesting that still, like I discussed with the statistic, one fourth of the people are actually looking at 30s, and in my late 50s, which is 50, 55 that we spoke about. So, again, that actually proves what we were just discussing earlier. So, it's an interesting response again. Okay, let's go ahead. So, what does retirement really, really mean? It, like I said earlier, it doesn't mean that you stop earning, or it's a negative word. What am I supposed to do? Sit at home, nothing. It really means that you have accumulated enough money to sustain your expenses or your lifestyle, at the time that you're basically retiring. So you're able to manage that lifestyle. That is what you need to focus on. So let's go ahead. Now, what is the first step that is there in terms of defining how do you even decide your retirement corpus? The first thing is defining your expenses. So, what are your current monthly expenses in terms of your rent, your travel, food, clothes, anything that are your mostly your needs, and of course some of your wants. So let's assume that your monthly expenses are, let's say, 1 lakh a month. So for a year, that would be around 12 lakhs. And let's assume that you work for another 20 years. So, at the time, after 20 years, if the inflation rate is 6%, that means that after 20 years, this 12 lakh expense is actually going to be 38.4 lakhs. So this is something, again, it's not intuitive. I'll tell you, it's funny that when you keep stepping up your expenses, we never look at this, or we never think about it that, let me just spend a little bit more on that same gadget, etc. But it's very difficult to put it in your mind that what 12 lakhs is expenses is today is actually going to be about 38 39 lakhs at 20 years down the line. And this is just for representation. Whether you look at a pizza or a burger, anything that was, let's say, like 15-20 years back has actually inflated. You look at your grocery bills, you look at any of your bills. So the first part is to calculate your desired monthly expenses that will continue in your retirement. Now let's go ahead. Now let's look at these inputs. These are very simple. If you think about it, the idea is that first you determine what are your current monthly expenses. Now, like I said, when you retire, let's say you're 30 or 35 and you plan to retire at the age of 55. Now, at that point of time, maybe, I mean, if you had kids, maybe your kids' expenses, their education, their marriage, maybe a home loan has already gotten over. In terms of those expenses are over. So, what you need to identify is that what do you really think will be the expenses that will continue post your retirement. So, therefore, let's assume that this is just one format. There are many other formats out there. The idea is to get you understanding how to do this. So, the first step is calculate your monthly expenses. So in this example, let's say your monthly expenses are about 50,000 rupees. Now, what is the percentage of expenses that will continue in your retirement? This is the same thing that I was mentioning. Let's say it's 50,000 right now, with certain expenses you think will not be there once you retire. So maybe it's 80% of those expenses, or 90% of those expenses, or 100% of those expenses. So that's the other aspect. Now, the next aspect is, again, what is your current age? So in this example, what we are saying is, let's say the person's current age is 25. What is the retirement age? And again, I'm taking it by the poll where 75% people said they want to retire in their late 50s. So let's say this person wants to retire at the age of 55. What is the life expectancy? Assume that the life expectancy is 85 years. Now is that factor which we discussed earlier, which is one of the most important critical factors, inflation. What is the inflation rate that you want to compound your expenses by? So assume we are putting it at 6% right now. And of course, like I said, you can put it at 7, 8, 9, considering the lifestyle inflation that is also there. The two other parts, or the three other parts, are from now. So you're 25 in this example, you retire at 55. What rate will your monthly investments grow by? Now, this is an assumption, and we will come later to in terms of asset classes and looking at historical returns. But if you look at in this example, we are saying 8%. So this would be a mix, of course. Maybe equity is given about 12, 13%, and debt is at 6, 7. So a blended rate. Again, this is an input that the user, that the person has to do. The other part is, have you already saved any money for your retirement, because that will also accumulate in value. That's the other idea. And the last input that I would say is, what will be the return from your corpus? So you're 25 now, 55 you retire. Assume you had to build a corpus. Let's say it's 5 crore. Whatever that amount is at the age of 55, how much do you get return from there on that corpus? And ideally, when you're already 55, you will put it in safer assets, because you need to withdraw that money. So again, this is something that is a return percentage that you would need to determine. In this example, again, I put it as 8%. Now, when you put these inputs, these 5 or 6 inputs, and you use some sort of tool, you'll come to the next slide where it'll actually get you to what is your retirement corpus that you need based on this example. So for a person who was aged 25 with 50,000 expenses per month, okay, who wants to retire at the age of 55, live till 85, inflation at 6%, gets 8% from rate of return from their investments now and 8% going forward, the number is about 7.9 crore. So this is the required corpus that that person needs. Now what? To maintain the same lifestyle at 50,000 expenses. And we will go to some slides later to explain that, 50,000 now equals to how much expenses later, and what does he have to do if he doesn't meet this. But why this number is important, now I'll tell you. This is, we are talking about retirement. There are other goals that you have: your education, marriage, car, vacation, whatnot. You only have a certain amount of money. So let's say your income is 1 lakh rupees per month. Your all your expenses are 40,000 rupees per month, as an example. So you have 60,000 surplus left to invest for all your goals, including the ones I mentioned and retirement. Now, how do you know that where to, prioritize? So obviously you'll prioritize for short term goals. The idea for this exercise is to be aware of what is that number, and now your next question should ideally be, okay, great, this is great, you told me that based on my inputs what is my retirement corpus, and I got it, as in I got the number. Now what next? So the next absolute question is, how much do I need to invest per month to meet this corpus? So if you go ahead, we'll see for this example, and this is a table which shows rates of return on the left side as well. At 8%, if you are at the age of 25 and you start, you need about 52,000 rupees every month to invest. And if that 52,000 rupees per month generates 8% rate of return, you will meet the 7.9 crore corpus by the time you are 55. Now, if you are able to generate a higher return, let's say a 10% return, in this case, at a 10% return, you're able to reduce that amount, because now you need about 34,000 odd per month to meet again that 7.9 crore corpus. Now, if you look at this, the very interesting part, and which is what we discussed in the first or second slide, that what we'll go through today, is, okay, what if I don't start at 25? Everyone doesn't have to start at 25, and that is also a choice. That is okay. There's no one saying that no, you're 25, put all your money, put exactly all this 52,671 every month in retirement. Now, the idea is that if you don't start at 25, you start at 30, see what happens. For every 5 years that you delay your planning, how much do you need to invest more? So, for this person in this example, let's say he or she waited another 5 years. So, waiting another 5 years means that they need to invest 82,544 every month. Okay, that's also okay. Okay, let's wait another 5 years. If you wait another 5 years, now your retirement age, you're not increasing. Your retirement age is still 55. So, if you wait another 5 years, and you start at 35, now just look at the difference. You started with 52 and it's almost triple. I mean, 50 into 3 is 150, almost triple. You need about 1.33 lakhs every month, right, per month, to invest. Now the idea is that when you're 35, right now it may look like, great, what's the big deal, I'll invest 1.33. But imagine, unless your income increases at a substantial rate, and you have other goals also to prioritize. So you have your vacation, you have your marriage, you have your car, you have all of that. Now, how do you decide that 1.33, by the way, this does not include all your expenses. So to invest 1.33 per month when you're 35 means maybe you need to make like 3 or 4 lakh rupees per month, take out 1.33 for retirement, take out another 80, 90 or 1 lakh for your expenses, and then some for your other goals. So now this should give you clarity in terms of how much do I really need to invest per month to meet that corpus, and what happens when I delay. A lot of times I hear people saying that, I mean, this is just one life, you only live once, etc. I agree, you do only live once, and you must optimize in terms of your prime when you're in your 20s and 30s, for your experiences, for everything. So the common understanding should be that there's a certain amount of income and then there's a certain amount of expenses. And so if you were not aware, which was in the first poll, where majority of people do not even know in terms of, like, the retirement corpus, or how to manage that, or how to think about that, then you'll be 25, you'll be 30, you'll be 35, you'll keep going ahead with that, but you'll never know, did I need 52 this month, do I need 70? Last month I spent more, so this year, let's say for an example, for the whole year, did I still make those investments? Am I on track to meet my retirement? Do I need to invest more next month or next year? Oh, I've got a good bonus. Should I allocate one part of it to my travel, etc.? Should I at least put some part of it to this goal because I did not do it? So this is the answer that you get by understanding all of these options. Okay, let's go ahead. Now we look at, okay, this is what I was talking about. What is the actual accumulated versus required retirement corpus? So in the example that we spoke about, the person needed about 7.9 crores, as we remember. Now 7.9 crores was needed to last all of the years in retirement, right? Now imagine, and this is what also you can figure out. There are a lot of tools, etc., just to figure this out. That okay, this is in paper. On paper and Excel, everything looks amazing. You can put 10%, 12%. That doesn't mean that you're actually doing that after building a habit. So assume that 7.9 crore you did not meet. Let's assume you only got 4 crore. What happens now? And if you look at the middle part, it says 50,000 expenses now inflated by 6%. What would be the amount of expenses that you need when you retire? Is 2,87,175. So that is 50,000 inflated by 6%. Now, if you only got 4 crores in this example, that means that the first year monthly expenses when you retire that you could afford is only 1,45,000. Now, let's say instead of 4 crores, you got 5 crores. Again, instead of 145, you could get about 181. But what happens now? There are two things that you need to be aware of, and two things that are critical. Assume that you want to maintain your same lifestyle, right? If you want to maintain your same lifestyle, what has to happen? First thing, you have to reduce the percentage reduction to be made in expenses to survive retirement. You need to reduce your expenses about 48, 49% if you only got 4 crore. Now, if you got 5 crore, you need to reduce your expenses by 37%. Why is this important? Now, once you do not meet the required retirement corpus or you have not planned enough, there are only two things an any individual can do. Like the kind of expenses that he was or she was making, they'll have to curb that because they'll have to be more frugal because they've not really achieved that amount because they will keep withdrawing that amount of money per month in terms of expenses. So that's the first choice. Assume they don't do anything. Now look at this. This could be a little scary part, but this is where I'm trying to make you understand that. For example, you got 4 crores instead of the 7.9 cr, okay? But you're not willing to change in terms of lifestyle. You want to continue with the same lifestyle, the same expenses. Now, what happens really in the first case when you make 4 cr, okay? The how long will the money last basis the corpus? What is that amount? What is that number of years? Just 13 years. So instead of the entire age in terms of 55 to 85 that the 7.9 crores was actually helping you survive, you'll only be able to survive 13 years. And in scenario 2, when you get about 5 crores instead of the 7.9, now the money will last you about 17 years. Now tell me one thing. You cannot decide. Like, you're not going to decide, no, today is the last day that I'm living, I'm not going to live after this. You will continue to have those expenses. So when you continue to have those expenses, you don't want the money to finish off in 13 years or in 17 years when you're going to live for 25, 30 years. This is something that should hit you again as a key takeaway, that once I'm done like really getting that income, I want to live my life and enjoy whatever I want to do, my passion, etc. This should not be a worry that, come on, like for my, if you're on rent or if you have a house, that's fine, but your groceries, your insurance, your whatever expenses that you have, which you really need to live, that should not be a bother at that point of time. And there will be more expenses as you age. Definitely, there could be more expenses depending on medical, etc. It should not bother you that now if you wanted to take a vacation, then oh, would you not regret when you're 50, 60, 65 and you wanted to do something, but you have to think, oh, this costs about 3 lakhs, 4 lakhs. I don't think I can afford it. Which is where you have to plan well in advance now, whatever age you are, and just make small contributions so you can actually get there. Let's look at the next part of this. Let's look at the next example. Okay, how far can your cash carry you? Again, this is the same example which says that at 7.9 crores, the money would last 30 years. But assume you didn't make 7.9, you made 10% lesser or 20% lesser. So if you look at 30% lesser, for example, again, that's 5.5 cr. And again, you need to reduce your expenses by 30% again, because it's a linear equation. You need to reduce your expenses by 30% if you still want to maintain the same lifestyle. Okay, let's go ahead. Now, this statistic is something which I also came across, and I think this is something, and you can calculate yourself as well. Will the inflation actually deflate your retirement corpus? We don't really think about it in our day to day living. That, like I mentioned earlier, that RBI's inflation, let's say 6%, 7%. We don't realize that lifestyle inflation is much higher. Like I mentioned earlier, there is an increased level of expenditure that we sort of do. So look at this. Assume the same example, that the current monthly expenses was 50,000. The returns from the investment were 8%, and the returns from the corpus again was 8%. Similar example, the current age is 25, the retirement age is 55, and the life expectancy is 85 years. Now, if you look at the required retirement corpus is again 7.9 crore. Now, if your inflation assumption within your model or within your calculation, you increased it by 1% from 6 to 7. Just look at the dramatic effect of inflation on the required retirement corpus. It increases by 50%. Yeah, just I'll say that again. It increased by 50%, which means that if your retirement corpus was inflating, your expenses were inflating at 7%, instead of 7.9 you would need 12 crores in terms of your retirement corpus. And if it was increasing by 2% instead of 6 at 8, that's about 18 crores. So you might not realize this, again, like I said, in your normal day to day, but when you're looking at 30 years down the line or 25 years down the line, even a 1% up down will really mean that you have to have a much higher retirement corpus. And if you can guess what my next statement will be, it will be that if you now require 12 or 18, therefore your investment amount per month will now dramatically increase, because earlier at 7.9 you needed about 52, but when it's double you need more than maybe more than double that same amount to invest every month to meet that new retirement corpus. Okay, let's go ahead. Okay. Now, if you look at, yeah, so this is exactly the same thing, which is now telling you in bolder terms that a 1% increase basically in the required corpus increases to 12 crores. That's about 51% increase, and a 2% increase in inflation, right? Means that the corpus required goes from 7.9 to 18 crores. So that's about a 129% increase. And again, don't be scared by all these large numbers. If you're planning in advance and we know what it takes, that's when we can at least meet near to the corpus at least, and then look at adjusting our lifestyle as well. Okay, let's go ahead. Again, this is the example that I wanted to show you, where again intuitively it's not you're not able to understand, but in 25 years, let's look at the same example, that in the impact of inflation on the purchasing power. So in 25 years, 50,000 will buy as much as about 11,500 buys today at 6% inflation rate. You can also look at it as an example that there's a rule of 70. So 70 divided by the inflation rate. Assume that 7% is the inflation rate. So 70 divided by 7 is 10 years, meaning the value of your money will halve in 10 years. So your value, if you're saying 1 lakh today, based on a 7% inflation rate, in 10 years the value will completely halve. Second part, in 25 years, again, like I mentioned, 2,14,000, etc. per month is required to maintain the same lifestyle that you're maintaining at 50,000 expenses today. So you can't just think about it that, okay, 1 or 2 years you can go ahead and think, okay, little bit. You'll not realize in 1 or 2 years. Frankly, whatever you spend on the last gadget or on certain expenses or services or goods or airfare or whatever, in 1 or 2 years you'll see minimal change, 5%, 6%. Doesn't change that much from 50 to 53, 55, 58, as an example, from 50,000 expense. But now extrapolate that to the 25, 30 years, and that will actually substantially increase the amount of money that you need in terms of your expenses. Okay, let's go ahead. Now we'll talk about a couple of things that now what have we done so far. Now you understood your retirement corpus, how to calculate your retirement corpus. Okay, you understood how much money does it take in terms of per month investment to meet the retirement corpus. You also understood that if you don't plan in advance, and you plan 5 years down the line, 10 years down the line, how much more do you need to really invest? So the cost of delay. You also looked at how inflation actually has an impact, right? So how much does an increase in inflation mean that your required retirement corpus is more? Now let's look at some of the investment options for building the retirement corpus, because that's the next question I get. And these are not exhaustive options, but the idea here again is that you have a mix of equity, which are your stocks, mutual funds, etc. You have debt, your debt mutual funds, fixed deposits, etc. And you have tools like PPF, EPF, NPS, etc. So these are just standard, historical return. Doesn't mean the basis that you can use this as going forward returns. So you have a mix of debt and equity. And while instead of going through each and every asset class, the idea here is to tell you that, let's say you're 30, or in this example you're 25, and you start off with an equity debt split. Maybe you start off with a 70-30 split, maybe. But towards your retirement, maybe 10 years before your retirement, 5-10 years before your retirement, you must start reducing your equity exposure a little bit. So let's say 3% every year from equity to debt, so that you get to a much higher debt exposure. So there is no golden rule. So I can't say it's going to be like at the time of retirement you should have 70% in debt and 30% in equity. Why? Because something that even Sona mentioned the first introduction, you can't customize it. Personal finance is what? It's personal to each individual. So what is your risk appetite and how you want to determine that, we'll look at that. But eventually, in general parlance, a little bit of debt exposure should be much higher as and when you're tapering down. And there's a theory to this. It's called sequence of return risk. And what that really means is, when you're, let's say, 55, or the period that you want to retire, now you remember you need a certain amount of expenses every month that you need to withdraw, or per year. So assume you put a lot of money just in equity. Let's say 80% of all your money is in equity, and the market stays stagnant or completely fall for 2-3 years. One thing that changes now is you still have to withdraw from that corpus to live. So you keep withdrawing, keep withdrawing. So it could be possible that the first 3, 4, 5 years, the markets keep going down, keep going down, even if they come up at a certain point of time later. But the sequence of return risk is something that you cannot manage, because you don't know the volatility or when it will go up, down. But you do know that you need to withdraw for your expenses, which is why the debt part of it, like having some sort of safe income which will keep actually helping you manage your expenses, is extremely important. So so you could look at your PPF, NPS, all of those options are there. So I'm not going into the pros and cons of each investment option, but basically talking about that, the debt and equity exposure. Okay, let's go ahead. Yeah, this is what I was talking about. What it's saying is that, from an accumulation stage point of view, so there is a distribution stage as well, but let's talk about accumulation only at this point. Where, again, in this example, when the person is 25 and he starts off at a 60-40 split, what we're saying is about 10 years before the retirement, the person starts tapering down the equity exposure, and here it goes up to, it completely reverses. So basically 70%, let's say, in debt and 30% in equity. But again, these are just general models. Of course, you'll have to consult a qualified professional and then figure out how this affects your personal lifestyle, etc. Right? Okay, let's go ahead. Okay, this is a couple of other things that I would like to show, is in terms of how do you determine like where to invest, right? So if you're looking at equity and debt, like I mentioned earlier, look at historical returns for different asset classes in India. Again, this is historical, so returns are subject to market risk, that you all know. So going forward, of course, you need to consult. But if you look at equity, even in the 10-year or 15-year period, historically it's given about that average 12-13% return. For example, again, with Indian equity or US equity, again, it's about 13-14%. Gold is, again, for a 10-year period, about 7.5%, and real estate about 5-6%, and debts 6 or 7. Again, these are based on certain surveys and research papers. But what I would want to also include here is that if you need a much higher corpus, so when we looked at that, you get 8% rate of return on your investment, you need about 52,000 in that example, if you remember. So for a retirement corpus, because it is such a long way away, hopefully, mostly if you're in 20s, 30s, you must have a certain amount of exposure to equity for sure. Why is that? Again, I'm not saying how much, but you must, based on your risk appetite, tolerance, and your lifestyle, and what your expenses, etc. are, you must have that, because that is one of those instruments that will beat inflation. Why do we need to beat inflation? Because we just talked about it, that a certain amount of inflation and an increase in inflation really increases your retirement corpus a lot. It really increases it at a certain rate that then you have to actually invest more. So an equity component is extremely important for a retirement portfolio. Otherwise, you will have to invest much more, because the if you look at the rate of return, if it's only 6 or 7%, you need a much higher per month investment. So these are just in terms of certain options. Of course, diversification is key, because you don't want all your investments to be in one asset class. So this is why you can't understand each and everything in an hour session, for example. But a qualified person will help you to manage your asset allocation, your portfolio diversification, and rebalance your portfolio as well to meet this retirement goal. Okay, let's go ahead. Again, this is again an example which looked at where how have asset classes actually performed, and this is why diversification is the key, which I was coming to. Now, if you look at this in terms of different asset classes from for the last 10 years, you'll see, I mean, it may not be so easy to see, but I'll explain to you that in terms of whether it is equity, large cap, mid cap, or small cap, whether it is debt, gold, real estate, anything. No, I mean, you can keep looking at the numbers, they're color coded, but you'll realize that no single asset class is at the top or the bottom in any one year, right? So you will see that for certain years, small caps are really doing well. Then certain years, large caps are doing well. So, which is why if you're not diversified and you put all your eggs in one basket, you may fall short. Therefore, how is this determined, and what do you really need to do? How it is determined is that you need to have your asset allocation based on one, your risk appetite, second, in terms of your time horizon or holding power, and definitely in terms of your goals. So you can't randomly go ahead and go and just invest because someone said small cap is giving 18-20% in the last 2 years. Let me put 70% of my money in small caps and let's see how it does. Because it's increasing at 18 or 20%, you might think, wow, awesome. I don't need that much money per month to invest, because if you, like we saw in that example, you, instead of 52, you might just require 30,000. But can you, I mean, I can't, but can you assure me that that small cap fund will keep returning 18, 20%, 22% every year for the next 25 years till the time you retire? I mean, if you could, then that's like genius strategy. But the point is, which is why the diversification is important, even within real estate. So I am not for or against any one asset class, but the idea is to get to a place that you're able to diversify appropriately. So this is where we've come together in terms of the asset classes. Yeah, I think yeah, another poll. Let's look at this poll. At what age are you planning to? So I think it's not age. It should be like in terms of what amount do you think that you need to plan to retire, which is fine. So take it like that. The first option is 1 to 3 crore. How much do you need in terms of retirement corpus? Second is 3 to 5 crore, and the third is 5 crore plus. So just keep it as. So we look at the responses, because this will help me understand in terms of how much do you think the retirement corpus is based on the statistics. So let's go. This will be an interesting response for sure. So if you look at that, it's about, again, one fourth saying 3 to 5 crore, and the three-fourth people, 75% people saying 5 crore plus. I would love to say the 5 crore people plus are right, or I would say, so I can't say yes or right or wrong to anybody. And if I have to give you the key takeaways in maybe like in the next 30 seconds, I'd say that this is exactly why you need to understand what your retirement corpus will be. So we started off with there. You need to be aware retirement is important. Why do you need to retire? I mean, why do you need to plan for retirement? How much do you need to invest per month to meet the retirement corpus? And I'm repeating so that you can't get everything in this 1 hour session, but if you can take two or three key takeaways, if you don't plan in advance and if you delay planning, how much more do you need to invest? How does inflation play a factor? It increases your retirement corpus enormously. So if you have this in place along with all your goals, with your income that you get, your budgeting, you'll be able to plan appropriately. And this is something, it's not just today, you'll revisit. Your expenses may change. Maybe after 2, 3, 5 years, you have want to change your lifestyle. So if you want to change your lifestyle, higher amount is needed to invest. Lower, frugal, you're able to maintain. So I hope you'll be able to take these key takeaways. And someday when the statistics will get reversed, what I want to see going forward, or me or a lot of other people would want to see, that more people have started planning early. More people do know what their retirement corpus would look like, how much do they need to invest, etc. So yeah, with that, I'll end this session and I'll get Sonam back. But yeah.
Absolutely, Ritesh. Thank you so much. It was quite an insightful session. I got a lot of view and a lot of insights from this particular session, especially with that data that you provided. Ritesh, before we move ahead and take the questions of the people, I have a question here. What are the basic mistakes that people do during retirement planning? What are the things we should definitely avoid while doing a retirement planning, please?
So I think the first thing is not listening to anybody randomly saying, "Oh, if you don't get 20 crores, you won't be able to retire." You ask that person, you give me your inputs, I'll put it into like a calculator tool and
Sure.
trying to understand what that corpus is.
Yeah.
Second is blindly investing for the retirement corpus, and again looking at just one asset class, or just stocks, or just five these blue chip stocks, and that's it. That's my retirement money.
That's right.
You need to rebalance and monitor. Just like everything else, I mean, imagine when you want to get healthy and you want to lose weight, you can't just go one day to the gym and get it over with. Every day you need to monitor and see, my nutrition. What it's again, it's an analogy in terms of diversification. So that's the other biggest mistake that people make.
Absolutely, you should not randomly fall for your retirement planning. Not just start doing it. It's not just one part. It cannot be only saving or it cannot be only investing.
Right.
It takes a lot of parts of it, and that's why a proper financial advisor can explain you how to go about it. And like he said, like there are these calculators out in the industry that can help you at least get started. That how much commerce maybe you will be needing. Obviously, it will be unique for every person, their health conditions, be it the family dependency, everything. How much does insurance play over here? Why I'm asking this question is after retirement, what happens to it? I mean, you are already in a position maybe where you will need a lot of healthcare and all, and then you have even planned your retirement and all. Where does insurance play in this particular space?
Yeah, that's
Ritesh?
also a very good question. I think, again, like we discussed, that medical expenses are actually
Yes.
inflating at like 14-15%. So you, of course, have your personal insurance, personal health insurance. That definitely, again, that penetration is low in India.
Yes.
People must get that. But your premiums also do keep going up as and when you become older. Which is why, imagine that if you're, God forbid, you have to have some surgery or something in terms of a medical
Yes.
expense, you're not able to cover only with your personal health insurance. Now, this is where the retirement corpus also comes into play. So, one, insurance is definitely a preventive method. That's something that you must have, and then you have to supplement it if required. You can't, you're not going to start taking a personal loan when you're 65.
Oh,
No one's going to give it to you for like maybe like a medical thing, right? So that's where
absolutely.
both important.
All right, let's get started with the questions.
Sure.
We'll not make you all wait for too long. Okay, Uttam Kale sir is asking, is it an effective financial decision to invest in gold? Like he said, only gold? No, it has to be diversified. Please go ahead,
No, I
Ritesh.
think I agree with Sonam. So again, if you're, it has to be a percentage of your portfolio. Maybe again, I can't determine if it's 5 or 7 or 10. You've seen what happens with gold prices recently as well. But it's okay to have a certain amount of diversification. Now, what type of gold, you'll again have to make that choice,
Yes.
physical or SGB, etc. But yeah, it's okay to have a certain percentage in gold because again, it's diversified.
Absolutely. Okay, Pankaj is asking, will we have access to the stock after live stream is over? Yes, sir, you will. You'll able to watch it on the One Finance website, on the LinkedIn platform of One Finance, and also on the Twitter platform. You can always go and watch it. Okay. Mr. Vivek sir is asking, how much monthly SIP required considering my current savings? Example 1 crore. Okay, this is again unique, like Ritesh said, that it will depend how much you're earning, how much you have that surplus income to put for your retirement and everything, and then obviously where you investing or where you going
Yeah.
about. Is that the right answer, Ritesh?
Yeah. And I think I'll just supplement that by giving one other advice which might answer some of the other questions. We always step up our expenses. We'll go for the next
Oh,
gadget or this
absolutely.
thing. But we very seldom step up our SIPs. I'll give you a very simple example. Assume that you're actually investing 25,000 every month.
Yeah.
At 12% rate of return and for 20 years. Okay. The amount of corpus that you'll get in the end is 2.5 crores.
Sure.
Now, just think about stepping it up just by 10% on an annual basis. So instead of 25,000, from next year you start, let's say 27,500. just by doing that one change, I know it looks sounds easy just by doing that one change,
That's true.
but if you can prioritize
Yes,
that,
yes.
the corpus that you'll get by stepping up will double to 5 crore. Just imagine the difference. So that's
Absolutely.
something which people should think about.
Absolutely. Like when you increase your salary, you always go and
Correct.
first go and buy something. Lifestyle spending is happening where you're going and buying a new gadget or something like that. Why not step up on that particular in your investments, in your savings, or whichever way that will help you more than that one gadget
Right,
actually.
right,
All right.
absolutely.
Another question is from Niyati. How many times one needs to review the retirement planning? If I have set everything in place, how many times I need to review it?
Now, this is again personal. You could do it yearly. You could also do it in a 5 year block. Because, see, if you need, for in the example that we were looking at in the session at 7.9 crore, you know every year also how much do you need. So, let's assume by the end of the first year, you need 50 lakhs. As an example, I don't remember the exact calculation. But now you know how much have you invested, what's the value. So, you can track it every year also, or you can track it in 5 years and say, oh, now my expenses are much higher. Now, baby, then you don't need 7.9. Now you need 12, then your monthly investment also increases. So you can track it regularly, yearly, or even like 2 years or 3 years block. That will depend on how frequently you want to track it as well.
Absolutely. And this question actually, another question is actually a part of this particular answer itself, that if global economic trends are changing, anything is happening, do I need to change my retirement planning? Do I need to start considering something completely opposite to what I had done? So, like we discussed, right, all these things keep happening around you, and you start selling your stocks, you start selling your investments. Absolutely a wrong way to look at it, but also need to have a rebalancing done.
Absolutely, because there are so many big, like not just recessions
Yeah.
or events that have taken place. But if I look at the long-term trajectory, even in terms of the markets, in terms of equity, I'm
Yes.
talking, it's up only. You get those 12-13%, but you won't get 12-13% every year. So it's over a period of time. You need to be invested. So when you say change your portfolio, again you need to rebalance. Now you shouldn't have everything and 100% in equity. Now that's wrong. Which is why again the answer is basically diversification.
Absolutely. Okay. Another question is from Anupam. He's asking how critical is to enter retirement debt free, and what strategies do you recommend for managing debt before retirement or after retirement?
Right. So I think, yeah, I mean, everybody would love to be debt free since the beginning, but we do have home loan, personal loan, car
Absolutely.
loan, even in terms of gadget loan these days,
Yes.
etc. So I think again, there's another strategy where if you have a larger loan, when you get that one-time bonus, you get some certain income, start prepaying that loan,
Sure.
especially in the early tenure because the interest is high at that point of time. If you prepay your loan, your the amount of interest that you have to pay becomes lesser, and the time period of your loan also reduces. You can also increase one EMI every year, assuming that you were giving 12 EMIs.
Absolutely.
You can also increase the percentage of EMI. Again, when I say these things, someone always comes back to me and says, no, but I don't have the money.
Yeah.
But that's where the prioritization happens. But there are easy ways to, let's say, for example, don't take on credit card debt, which is very high interest debt, which
Absolutely.
some people may not pay on time, pay the full amount, do not pay half. So these are the kind of things that someone can look
And
at for
this
debt free.
is, taking us to the topic that when you are doing retirement planning, don't forget liability planning.
Correct.
Because if that is a mess, your everything can, turn up into a
Absolutely.
down spiral. Absolutely, where you're not going to be able to manage anything if one liability impacts you that hard.
Absolutely.
So everything has to be done together. Your investment planning,
Right.
retirement planning, your liability planning, it has to come together.
Absolutely.
All right, this is a very interesting question. I think a lot of people would like to understand on this is that what about taking your legacy ahead, or how should you plan your particular will while you are entering into retirement? Very important. In India, people do not have a will.
Yeah.
Multiple people go into disputes in the family. A
Absolutely.
lot of assets go unclaimed, still at banks, and a lot of places there are unclaimed assets in numbers today because they are not doing that one will that they had to do.
Right.
So, will planning extremely important part of retirement planning?
Yeah, it does become an important part because I mean, first important part is to get the corpus to help you live that amount. Now, if whatever you have left and your investments and assets, definitely in terms of a will is important because even if you have a nominee in
Yeah.
a bank and you've let's say you nominated your son,
Yeah.
but let's say your daughter comes up and says that this is actually I'm the legal heir.
Yeah.
It could go into a court this thing, but the will supersedes the nomination. That's the idea. So again, there are a lot of benefits like no fighting, etc., and equal distribution easily, not equal, but whatever is written in the will. So I think will it becomes also an important part of retirement planning to give away the next part of it.
Absolutely. At least put down all the assets that you
have in
have.
one
You
place. You
people
should
don't
know.
even know that which
Yeah,
assets have been
absolutely.
blocked.
Right.
Okay. What are the unique challenges that woman has to face when planning for retirement? This is very important. Like we have not covered this today in this session, but women actually live more than male. They have to live without a partner for a really longer time. Their retirement is actually more important also because they have to live all by themselves independently, and obviously they should not be like in such a position where their dreams have to be now completely put aside, goals have to be completely put aside because they don't have a partner or something like that. Their retirement planning actually comes first. What's your view on this, sir?
So actually, I've done a lot of sessions for just women as well, and I think the idea is that, again that yes, definitely in terms of they probably live longer, etc. It's about awareness. Absolutely. If they are also aware, because the participation of women in terms of financial instruments, etc., is much lower. Yeah. So in terms of whether how does a mutual fund work, how can I just start a simple index fund, how can I start an SIP with a small amount? Because eventually, imagine. I mean, again, I'm not doing any biases,
Yeah.
etc. But in general, women like manage the households. They're good managers
Absolutely.
in terms of also in terms of money as well.
Yeah.
So they do the budgeting of the house. If you think about it, so actually, if they can do the budgeting of the house, definitely once they know. So again, this session or other sessions look at awareness. So even if the woman now knows, oh, this much I need to invest every month, they'll start budgeting for that appropriately, and they'll be able to maybe do it even better. So that's how I think they should look at it.
Absolutely. Women need to do their financial planning also separate from their partners or the male partners so that they are also ready for these important milestones, financial milestones of life when they are maybe want to live independently. Today, women are very strongly a part of the workforce and they are earning good money out there. Why not just put it in the right track, just like the male partners are doing or something like that? So yes, women need to start working towards it, and also the will part also comes for the woman also.
Right.
Do not forget you also have assets and you need to put that on a paper to for your legacy. All right, let's take one last question.
Sure.
Anup is asking, would NPS investment be beneficial or better to put the amount in ELSS or normal equity mutual fund, and that would be more efficient because of 40% amount block for annuity? Again, situation to situation, but any particular answer you want to go
Again,
towards?
yeah, like you said, it completely depends on the individual. Again, NPS, like you rightly mentioned, at this point of time, the rules say that at the end of 60% can be taken out tax free, but 40% gets into an annuity. Now, just think about it in a different way. Now, again, it depends on people to people. There's a lot of psychology which goes into money, investment planning. I mean, people would have read the psychology of money as well. When you look at ELSs or equity mutual funds, ELSs have a 3-year lock in, and mutual funds depends on your lock in. Like I was mentioning to Sonam before the session as well, that 97% of people actually withdraw their mutual funds less than 5 years, and only 3% keep them. Now imagine that within NPS also you have different structures. You can do equity debt. You can also give instructions as to how much, and then depending on age as well. But just imagine that because in NPS it is locked till the time 60, you have no option. You keep investing every month, right? And you can't take it out unless certain conditions are met, etc. Now within equity, markets crash, COVID happened, something happened, you took it all out. Now how many people are like kicking themselves? They didn't invest during COVID, or they took out the money double, tripled. But if you were locked in already, you had no option. So for me, that might be a good thing, and I do NPS. But maybe for someone else, no, NPS equity mutual funds give maybe 3% more. I rather be locked in, keep monthly the money going in. But then again, NPS doesn't form all my portfolio. It's one part of it. So again, just to sum up, it's again you'll have to, from an investment point of view, it is going to be about diversification and how much again that you are able to. If you were able to keep doing that and not take out your money for 10 years, then great. Just try do equity mutual funds as well, but again balances out.
So when we're talking about NPS, also the important part comes the tax part. When you're withdrawing huge amounts after, during your retirement or after you are set and you're free now, you're going to remove a lot of lump sum amounts from the market, be it any places. The taxation impacts. How much they need to be ready for that?
Yeah, and that's a great point, especially post the budget in terms of your long-term capital gains or short-term capital gains also going up, but your long-term capital gains, So taxation is also important. But I'll again say, people should not plan their investment strategy for retirement basis taxation. Some people are like, oh, I'll get that 50,000 tax reduction in NPS. So maybe they'll only put 50,000 every month. 50,000 every month, or sorry, every year will not really get you any substantial part of corpus. So if you're really investing in NPS for your retirement corpus, like we said, know your part, how much you need, and then invest that. Then if you're investing, getting an additional benefit of 50,000 part of tax exemption, then that's great. But just don't do it. Oh, just because I'm getting ELSS tax exemption, I'll do it. Take it out after 3 years. So that's how
So no
taxation.
investments should be done actually to just save yourself from
Correct.
taxes or something. It should be smartly planned so that it is diversified also and gives you all the benefits and all the particular plannings that you have done.
Absolutely.
Be it your taxation, be it your retirement, or be it your liability planning. All right, this was the end of the session, sir. We have taken a lot of questions. If your question was not taken, we'll try Ritesh to and connect with his team to reply all those questions, answers, whatever they can. And yes, the page will be open for you all. You can see the live this session, which is recorded and on all the platforms on the One Finance website, on the LinkedIn platform of One Finance, and Ritesh has also shared it on his platforms and also on the Twitter platform. So go and see the session. If you've missed this, do share it with your friends and family because retirement planning is something that everyone has to do. Thank you so much, Ritesh. It was quite an insightful section, and thank you for doing this for us.
Thanks a lot, sir.
Thank you
Thanks
so
a
much,
lot.
Ritesh,
Thank
sir.
you.